Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. Today is Wednesday, September the 8th, 2010, and like we do every night, it's time to look at the markets. Check this out. Okay, somebody asked me to look at gold for them. I want to point this out because it's going to kind of go with today's market analysis. I want to point this out. Here's your main support. Here you rallied up here, pressed against the upper Bollinger Band line, touched the middle Bollinger Band line, bounced back up to the upper Bollinger Band line. By every stretch of imagination, you are overextended. You do not, I repeat, do not have a clear buy signal here. You've got an inverted hammer right here, which doesn't go away. It doesn't get alleviated. You pull back down. Never happened. And you're still pushing higher, and you've got another inverted hammer right here. These are telltale signs telling you to exit. Tells you someone else is exiting. You also notice you are overbought up here. Oh yeah, okay. So with no support except for way down here, when this guy does break down, he's got a lot of room he can fall before he ever hesitates. Okay, so it's becoming a very dangerous trade on the long side if you're long this market. At the same time, I wouldn't be short because of the currency issues and this and that over in Europe and so forth and so on. So that's driving gold prices higher, which makes you wonder why are the world markets, not all of them, but the majority of them going higher while gold is going higher. Let me show you what's going on in the world market. All right, let's start off looking at the NASDAQ. This guy was up 20 points for the day, or 19.98 points for the day. None of that really matters. The end result, boom, you're there. If we've been waiting for that overbought condition of the slow stretch, you've got it. So you can still press higher, just like we saw on the gold chart where we showed you the inverted hammers, the sell signals were already there, and they still pressed higher. That's fine. We don't mind if they press higher. It's called a fool's rally when that happens. If you were to buy right here, right now, and rally up, how would you know when you're overbought? You won't, because the overbought condition's already met. You cannot safely buy here when you do that, and even if the market pressed higher for days, I don't care if it's 3 weeks. We've already seen that back here, all right? Remember those 3 weeks time period? All these people thought they were getting a real steal of a deal, right? Beating the market, and then, whoops, okay? Don't argue with the chart. The chart's never wrong. You have to understand what can happen here, but know that in both cases, you have either a sell-off or a rally. It's a fool's rally that ends in a sell-off. In both cases, you short. Another example of a fool's rally back here. We said inverted hammer, short. That's it. You had these signs right here. She fought it anyway. And a lot of people thought they were getting away with something until the flash crash. All right? It doesn't ever break the rules. The rules are there to protect you, to keep you safe, but they only work if you use them. Okay? I'd like to point out also on our free website at PerfectStockAlert.com. In our chart skills section, we have a video we posted last night titled "The Fool's Rally and How to Spot Them, How to Use Them." And they have telltale signs. Number one, low volume, like this. Number two, lots of gaps. 1, 2, 3, 4. Count today. Let me clear that up a little bit so you can see those again. 1, 2, 3, 4. Okay, very bad. On the upside, you've got 1, 2, 3. This is not an exhaustion gap. This is a breakaway gap. It's different. So you have 4 gaps below the have to fill. You're overbought here. You have no volume to the upside move. Yes, you can still press to the upside, but it will not be sustainable. That's the important key factor. Is it sustainable? If it's not, it's just a short. Here we are looking at the Russell chart, the Russell 2000. This one's a lot clearer. Still overbought right there. Very much should be shorted. This is an obvious short opportunity here. You are showing the bearish divergence right here and right here. That means when you get that counter trend bounce, you want to use that for your short opportunity. That's a textbook method. You can go to the website, you can look anywhere on the internet and find that example clearly defined. You get a bearish divergence, you want to let that bounce happen and then use it to short it. Okay, so any bounce I get to the upside here, it's a short opportunity, and I wish we'd get a couple more days of it because I'd like to get a little more of it. The S&P 500, a same old story. Okay, and we're showing the same little reversal situation like I want to do today. Very weak bullish signal there for today's activity, but I would point out that we do have the unemployment data coming out tomorrow, and that's expected to be first thing in the morning. It's going to, I would expect it to be bad, but no telling how they're going to spin it, so don't worry about it so much. But it doesn't matter really what they do. If they move to the upside, it's just another one of those fake fool's rallies that you don't want to be involved in from the long side. Remember, had you used this situation back here when they had the last fool's rally at that point, any time during these 3 weeks you could have shorted and you made money. Okay, Back here, a fool's rally. You had a short right here, overbought conditions, and she still fought. Had you shorted any of this time, you made money. Okay? Same situation, potential setting up right here. She can roll over first thing tomorrow, or she can fight it like she's doing today and just keep going, trying to convince some retail investors that it's okay if you just buy. We could maybe. All right? Don't be fooled. The Dow Jones Industrial Average up 46 points on the day, taking back about half of the losses from yesterday. But the main thing to note here is that 200-day moving average. We've been talking about this for the past couple of weeks. Whenever you're in a bear market, price activity will remain below the 200-day moving average. Whenever it bumps above it or to it, it's a short opportunity. All right? So now we're just trading just below it. If they were to move to the upside, fine, short it. All right? You're already there. Pretty clear, pretty simple, pretty easy. If you've not been to our free website at perfectstockalert.com, it's right there. It's 100% free. All we ask in return, refer a friend. Also, please subscribe to our YouTube channel by clicking on this video, double click it, whatever you have to do to get to the YouTube channel, and just click the little subscribe button right there. It's free. It just helps us stay free, and we appreciate that support. Thank you very much for that. A quick look at our disclaimer. The disclaimer, read it and weep. Okay, quick little update. We just crossed 2,700 subscribers on our YouTube channel. Thank you very much for that. It's because of you guys sharing our videos online, referring your friends, and sharing them on Facebook and Twitter, etc., etc. So thank you very much for all that. I appreciate that support. Also, those of you guys that are looking to find out what we're going to be getting involved in this week on our top picks, go to our free website, check it out there. And I hope to see you all in our live trading course come tomorrow morning. God bless. Take care. See you all tomorrow.